Hello there. Well, it's been a volatile few weeks on the stock market, and in the first couple of weeks in August we saw some of the equities fall really quite sharply before rebounding and regaining most of their lost ground. So for example, in the US, the main stock market, the S&P 500, fell a little bit less than 10% from its recent peak before rebounding, but the tech-heavy Nasdaq index fell more than 13%. But the big moves were in Japan, where the Topix fell almost 25% from its peak. Although for sterling-based investors as we are, that fall was cushioned a little bit by the rise in the yen, the Japanese currency. So what's been going on? Well, it's been a little bit of an interesting couple of weeks. I think the real catalyst for these movements was when the Japanese central bank put up interest rates, and that's for the first time they've done that in a long time. They've had interest rates at close to zero for many, many years, and they put up interest rates at the same time as other central banks are looking at cutting interest rates. And that has a big move on the currency in Japan, because a lot of people like to do what's called a carry trade, where essentially they borrow money in Japan at those very, very low interest rates, and they take it overseas and use that to invest somewhere else and get a high return. Now, as interest rates went up in Japan, basically a lot of people decided to unwind those carry trades and take the money back into Japan, and that pushed up the value of the yen. And Japanese stocks are very, very sensitive to what happens in the currency because there's lots of exporters there. So essentially when the yen went up, the stocks went down. So that was really kind of a local issue, but it was exacerbated by some economic news in the US, which was a little bit disappointing, shall we say. And so people were a little bit worried about a recession. And then we had the news that Warren Buffett has actually sold a load of his Apple shares recently. So you add all these kind of little things together and it just caused a few fears, and stocks fell really quite sharply. Now, we've been saying for a while that we thought stocks could have a correction, but if it happened, hopefully it would just be temporary. But we certainly didn't expect something quite as sharp as we've seen, which was, as I said, over a couple of weeks it fell and it's pretty much now already recovered. So we think it's actually more of a technical issue with all those little things. It's not probably the correction we were expecting, if you know what I mean. So it is still possible that we could still have something of a slightly longer pullback. Again, no, don't think it would be something to worry about. But again, I don't think it is that this correction means that we're not going to see it. But the good news is that during those couple of weeks, all the things that we bought in the portfolio that we thought would sort of hedge our equity positions, if you like, did really well. So for example, government bonds did really well, and they tend to do well when people are worried about recession, because central banks tend to cut interest rates if that happens, and that makes the sort of the yield on the bond look more attractive, so they go up in price. And we also have some other products that we would call portfolio insurance products, essentially, that are designed specifically to try and gain if stocks fall. And they again did their job. They went up when they were meant to. They've also then gone back down again as stocks have recovered. But it just proves to us that it's the right thing to do to try and hedge those positions, have those things in the portfolio. And if we did get another sell-off, what it would mean is then we could potentially sell some of those, hopefully at a bit of a gain, and then use that to buy into stocks at relative lows. Now, we did a little bit of that in some of the more adventurous portfolios in the last couple of weeks. But again, just because of the speed of the movements, we only did a small amount of that. So it's been volatile. There could well be more volatility to come. As I say, I wouldn't expect it to be anything particularly to worry about if it does happen. But as I say, we've positioned the portfolio to try and take into account and try and take a good position if that were to occur. So thanks very much. We'll see you next time.